Hello and welcome to the iClubcentral webinar on club operations. This is Russell Malley standing in for Doug Gerlach this month, and today we're going to be covering understanding the IRS audit rules for investment clubs. And today is March 18th. And with that, why don't we get started with some who's going to be here. So I'm presenting tonight, and in the back office we have Sean Pulrang, who's our senior support representative, and also Chivo Dildine, who some of you may have already talked to at times, another one of our wonderful member support people here at iClubcentral, and she also does a lot for better investing. If you have handouts, there is a little handout item in your control panel for GoToWebinar, and there's handouts there. And if you have questions, just type them into the questions box. They'll go to Sean and Chiva in the back office. If they think they need to be answered by me for everyone, they'll interrupt, and when we come to questions, give me the question for me to answer for. So for tonight, the purpose of this webinar is to explain the IRS audit rules as they pertain to partnerships. A few years back, these rules changed, and we'll review some of the requirements and procedures for opting out of the new rules, which is a benefit if you can opt out. And if you cannot opt out of the current rules, what you can do and what might go wrong and the consequences for not being able to opt out of the new audit rules. Okay, our disclaimer, we do not give personalized investment advice to individuals, nor personalized tax advice. So take that into consideration. We're not going to give you personal advice on these things. And now, what are the audit rules for partnerships? The Bipartisan Budget Act of 2015 changed how the IRS conducts audits of partnerships, and this will include limited liability companies. And the object was to make it easier for the IRS to collect taxes, and by making the partnership pay the taxes rather in past years, making it have the IRS go after the individual partners. So beginning in the tax year ending December 31st, 2017, these new rules became effective. They're called the Centralized Partnership Audit Regime, or CPAR. So what are some of the audit rules? So taxes and penalties now due to the IRS will be payable by the partnership rather than trying to get to the individual partners to pay that. All right, and the taxes and penalties are payable effective in the year of the audit, not in the year that was audited. So if you get audited next year in 2025 or 2026, and they're auditing 2023, you have to pay it. Everyone who's a member in 2026 would be paying the taxes, not anyone who had left in the meantime. So that means current partners may be liable for errors, omissions that occurred when they weren't even a partner yet. So that's the downside of the new audit rules. So who's affected? Well, it was primarily aimed at large partnerships, those with more than 100 partners, though the rules apply to all partnerships and LLCs. There are no exceptions, except for the couple ways that you can opt out, and we'll be covering those in a few minutes. Okay, and most small partnerships, and especially better investing style investment clubs, should be able to opt out. So how do you opt out of these new rules? And it's really quite simple. There's a section of the IRS tax code, section 6221, that gives you the conditions that if you meet them, you may opt out. These are the small partnership election. To make that election, you have to have less than 100 partners. You can have no trust as partners, and the IRS took that very strictly. That includes revocable living trusts that report their taxes on the trustor's social security numbers, and not the trust doesn't have to have its own social security number or tax ID number. So as long as it's considered a trust, no matter how it reports its income, you cannot opt out if you have a trust as a partner. And then all of the other partners, they must be either individuals, C corporations, foreign entities that would be a C corporation under US law, S corporations, or estates of deceased partners. So if you meet those conditions, you can opt there, your club or other partnership can opt out of these new audit rules. So that brings up a lot of clubs now are having members who are older, and they're considering having their partnership interest in the name of their revocable living trust. So if your partnership is considering that, these are some important things to remember about. You won't be able to opt out of the new audit rules, and you'll have to think, we'll get to what are the consequences of opting out, and then you'll have to balance whether the benefits of having your members listed titling their partnership interest in a revocable trust, whether it's worth the other consequences and possible liabilities of not being able to opt out. So if your partnership club decides, yes, we will permit them, then you'll have to fall under the new centralized audit regime. Now, if you disallow trusts, then you can still opt out of the new audit regime. And that, if you can, it's really a benefit to opt out if you can. So also, if you do opt out, or if you decide not to opt out, or you cannot because you have a trust as a partner, the new law also requires that you must appoint a partnership representative. Under the new rules, this partner representative is the only person that the IRS will deal with concerning your tax issues. Okay, it can be a member of the club. It doesn't have to be a member of the club. The requirement is that the partnership representative must have some substantial presence in the US, and that means maybe they own a business, they are a citizen of the US. The law is a little vague on exactly what that means, but that's the language in the tax law. Right, so you could, if you have an attorney or an accountant that you trust, you could appoint them. Now, if the partnership doesn't designate a partnership representative, the IRS will appoint one for you if in case there comes an audit. Now, there is a designated tax matters partner on Form 1065. The partnership representative is not that person. They don't have the same duties as far as the IRS is concerned. And if you cannot opt out or decide not to opt out, the IRS will deal only with that partnership representative and not the designated tax matters partner. So if you have a designated tax matters partner, you could appoint them to be your partnership representative also. So this means you probably will want to consider updating, amending your partnership agreement so you can take into account these new audit provisions. Things to consider: how will you go about selecting your partnership representative? Put requirements on the partnership representative. So it has to, such as it must inform the partnership of what the proceedings are and update them on what the IRS is saying. Put some limits on the representative's authority, because by the tax law, they have all authority to make agreements with the IRS and bind the partnership to those agreements. So you can put them into your partnership agreement and make sure that you limit their authority on your side, because the IRS will not limit their authority. And if you want to make sure you can always opt out, make it easier, just don't disallow living trust as partners or any other type of trust. Right? And then make sure if you're opting out, the club should know what needs to be done to make sure you can continue opting out. And if at some point you decide, yes, we will allow trusts, the benefits of those for estate planning are great enough that we'll risk the other factors for the audits. Then club members should be told what the possible ramifications that are, and also any new partners, they should be told. And you can see we have some on a blog post, a sample text of what could go into your partnership agreement. And here we have it here. You don't know what that is, those little squiggly lines after US code, those just means, one means section, multiple ones means sections. So these are the relevant parts of the Internal Revenue Code about the new partnership audit regime and how to duties of a partnership representative, and also how to opt out. So how to opt out? Well, the law says you have to do it every year. So there's a little part on the 1065, I think it's on page 2, the Schedule B, there's a little question. Do you meet these requirements and do you wish to opt out of the centralized audit regime? So you just check that yes, and you have to do that every year if you meet the requirements that you can. And in our tax wizard, that question will come up and you just answer yes. And the conditions that you have to meet will also show there, so you confirm. You will also, after you confirm that and you continue with the tax manager, there'll be a page where you have to confirm the entity type of each of your partners. And if you click on that one of them is a trust, it will automatically say, no, you can't opt out, and we'll change that. So, and again, remember, this must be done every year. You can't make a blanket opt out and say, oh, we want to do it for the next 3 or 4 years. No, it must be done every year, and it's part of your 1065 filing. So here's an example of there's the question with some of the conditions that you have to meet. So you just click yes or no. Yes if you want to opt out, no if you think you do not qualify or you decide you just don't want to. I recommend that if you can, please do. And then if you do decide you are not opting out, you do have to fill in designate your partnership representative. And that's just the next step there in the big red oval. So what if you can't or decide you don't want to opt out? What do you do about that? Well, if you do not opt out and you find you've made an error or you need to change a previously filed 1065, you do not do it by filing an amended tax return. You first have to make a request called an Administrative Adjustment Request, or an AAR. All right, this is IRS Form 8082. You still may need to require to file an amended 1065, but you must, if you do, you have to file it with the Administrative Adjustment Request. Now, if you're doing that, remember, if you're making changes to a previous year, it may mean, if the changes are large enough, your members may need to file amended personal returns. So people should be aware of that. So here's just part of Form 8082, and I think that, see that C1 is the partnership making an election under Section 6227 to have the adjustments taken into account by the reviewed year partners. That has to do, there are 2 different types of AARs you can do, and that has to do with one that is to your advantage if you can do it. So here's the 2 types of AARs. They both use the same form, but if you don't check the correct box, you will have the default type. And in this case, the tax, any tax due, is paid in the year the AAR is filed, and the tax is paid by the partnership, not by individual partners. All right. The other type is called a push-out AAR, and you need to make that special election to be able to do that. And in this case, the tax is paid by the partners who were partners in the year being reviewed. So if you're having an audit from 2023, you can, and you didn't opt out, and you want the partners who were partners in 2023 to be paying the tax, you would need to elect this push-out AAR so that the IRS knows, oh, the partners who were partners in 2023, they're the ones who will be responsible. Now, unfortunately, this is pretty new. My iClub does not support the IRS Form 8082. There are also more conditions. There are several more possible forms you may have to file with your AAR. And here's the IRS webpage. There's a link down there at the bottom. That should be in the handouts too of the slides. That gives the information on filing AARs, who must file them, how to file them, and any other forms that might need to be filed with them. So we talked about it a little bit before. If the club chooses not to opt out, you really should make this information available to all the current partners, but also any prospective members. Because if you have to file an AAR, that's a default type, they will be responsible for any back taxes from past returns that didn't get filed properly. So, and it's just good practice to inform anyone joining the club or considering it to make them aware that they could be liable for past tax problems. And the possibility, well, maybe we might be able to file and not do that, but it's certainly a possibility that they might be liable for the club's past tax issues. So that sort of takes us to, well, how likely are clubs audited? You know, if you're very unlikely to be audited, then it probably doesn't make too much difference whether you opt out or not, because it's really only, these new rules only apply if you're being audited. So better investing style investment partnerships have a very low audit probability. I think in my 25 plus years of helping out as a volunteer for Better Investing and working with my iClub and its predecessor, EasyWare, I have never heard of a BI style investment club being audited. That's not to say they don't, but no one has ever informed me that they've heard of an investment club being audited that follows better investment style operations. The main thing they're really looking for, do you have employees or business operations that generate tax liability? Better investing style investment clubs have neither of those. So all of it's on investment income, and those tax liabilities pass through to the partners. So you can limit your chances of an IRS, even though they're low, you can make them even lower, right? Keep good records. Check your records to make sure they're accurate. We've covered that in how to audit your club accounts multiple times, usually around the beginning of tax season. Make sure you're filing your returns on time and that they're accurate when you file them. Your My iClub settings are accurate, such as the type and country of each security. I would also add that your allocation settings, make sure if you're a new club, they are the default, that you're doing time-based. Avoid securities other than common stocks. These can lead to errors, especially things like doing dividend reinvestments. That has a lot of tax lots that you have to keep track of, and it's easy to lose track of them and think you're selling one and the broker thinks you're selling a different one. Avoiding REITs, they have special rules for them, and you have to recategorize the distributions you receive during the year. They're considered usually dividends when you receive them, but come tax time, you find out, well, it's part dividend and return of capital and long-term capital gain. Oh yes, that's special section 1250 unrecaptured capital gains, which is a subset of capital gains. So you have to do extra work, and also it adds to the possibility that you make errors and possible set up a red flag for an audit. Okay, that takes us to questions. Sean,
Russell, we had
Stephen?
one. We had one from Marty Eckerly. Says belongs to two clubs. One allows trusts and the other does not. Can he be a trust in one and an individual in the other?
Well, that's up to him. He could if he wanted, but he has to be cognizant of the risk in the one where he's at a trust, and they're, they may be, liable for past errors. But there's no rule that says you can't do that. You can be an individual one and have your title and trust in the other one. So you just have to make sure, where the club where you are a trust, make sure that you cannot opt out in that club. And I see, oh, I didn't catch this. My email address here is wrong. It's actually just rmalley at ICLUB.com.
Okay. I think that was the only sort of big one there. Someone asked about dividend reinvestments, but I think you touched on that a little bit there. Late question there while you're typing. We've got one for someone asking, is there a particular deadline for eliminating trusts? I suppose.
Oh, since you have to file every year, just eliminate a trust before the end of the year. And then at the end of the year, you don't have any trusts.
Okay, so it's not like a by March or October or anything of the year. Okay.
No, just if you eliminate the trust and have it listed in an individual before the end of the year, then the K1 will be in the name of an individual. So that should be the minimum. Make sure you have no partner is a trust at the end of the year. It'd be better to do it, right away, but at least by the end of the year. And when you mention timelines, if you do not opt out and you have to file AARs to make adjustments to correct incorrect things, and there is a deadline for those also, but it's the same as amended returns. It's 3 years from the time you file the original return.
Okay. I think that's. Well, I don't know. We might be getting into the realm of iClub has a support request page for a reason, but at the risk of that, one more. Someone asks if there's a request to have a distribution after death made payable to a trust, would there be a particular tangle for that?
No, there shouldn't be, because the trust was not a partner. It was an individual, and it doesn't matter who the heirs are receiving the at least as far as I know, it's the trust has to be the partner and not the heir of a partner. Well, I guess unless the partner was a trust and the heir of the trust or beneficiary of the trust was another trust. But the rules to be able to opt out have to do with who is the partner and not who is receiving a distribution on death of the partner.
Okay. Let's see. See, does the club need to address suggested partnership agreement language every year? I mean, I think that's an easy one.
No.
Not really. If you've put it into your partnership agreement, you might take a vote every year to say, are we all happy with the wording of the agreement? Yes or no, but not necessarily having to go over the whole thing all
Yeah, I like the
over.
analogy of your partnership agreement is like the Constitution of the United States. It's more broad principles. And then if you have bylaws or operating procedures, uh, those are things you can change more frequently, and they're more like individual laws. So that's the analogy that I've always liked. So once you put it into your partnership agreement, you're planning on it staying there for quite a while.
I think that's everything. I'm just looking through question about trusts, I think. But yeah, I think otherwise I think we're all wrapped up then.
Yep. So takeaway, if you can, avoid trusts of any type in your partnership agreement so you can opt out. While it's probably pretty rare that you might get audited, you might as well take the precaution and have the audit rules more in your favor, which you can have if you can opt out of these new centralized partnership audit regime. And it's really easy to opt out. Just meet the requirements and then make a checkbox on your return every year.
All right. Well, Russell, thanks. There was a lot of information in there. Folks, as usual, should be posting this within a few days on the My iClub site. If you're signed in to your club, might be at the end of the week, but if you're signed into the club, you can click the videos tab, and this one should be posted up fairly shortly if you want to rewatch, and that will include the handouts as well in case you like to take your time and read through as I do. So otherwise, everybody's saying thanks. So Russell, thanks again, and
okay.
we will.
And then you can have fun like me. If you have other questions, you can go and look at the IRS and the tax code. Lots of fun.
All right. Well, folks, we'll see you. We'll see you in a few weeks then for the next show. Otherwise, have a good night, everybody.
Good night.
Bye.